we have current assets and current liabilities in this sort of working capital formula. So what do you remember the ratios? The current ratio and the quick ratio. You remember the biggest problem, I mean not problem, but the biggest point of thought at this occasion? Yes, this was this famous inventory. You know that we have stock. We put our money into raw materials on stock, or it is in our finished goods, but it's still stock or inventory. So inventory plays absolutely crucial role, and it's absolutely the most important in working capital management. So here we have the definition. Inventory is the account of all the goods a company has in its stock. Raw materials, work in progress, and finished goods. Yeah, there are like three types generally. And then there is an example like you have the clothing production, and then you have like fabric or material, tissue. So it could be a raw material when it's still not in production, work in progress when it's just being cut and put into some clothing, and of course it could be in finished goods when it's ready for sale. Now we have the first and the most important concept, which is inventory turnover. Because already when you hear this inventory turnover, you have this image of your stock being turned over and over and over. Because this is the number of times a company sells and replaces its stock of goods in a period, usually 1 year. As such, inventory turnover reflects on how well a company manages costs associated with its sales efforts. You know, and of course, the higher the inventory turnover, the better, because it means that you you produce and you sell your goods quickly, and there is a demand for your products. And if you have low inventory turnover, it might indicate loads of different problems, but maybe sales are weakening, maybe generally your product is not demanded anymore, and you might have an obsolete product. It's quite a question, many questions with a low inventory turnover. And some more explanations. Yes, this in very short way. If it's high, means you manage your stock well, because you purchase, you produce, you sell. Yeah, it's not stuck in your premises and in your books as money. And as well, if you have it in details, you might have it in detail and show that your sales and production and purchasing are in sort of online, that you are able to foresee it and then to do it accordingly. Now, how we calculate this inventory turnover? Because there's as well quite a number, we'll talk about that in a moment, quite a number of different approaches to how to calculate that. But a typical turnover ratio is how much inventory is sold over a period. So in order to calculate, we take the cost of goods sold, and we divide it by average inventory of the same period. Again, it could be the end inventory or average, depending what is your principle of your analysis, or depending what are the principles legally. But to make it more sense, we do it generally by average inventory. So this ratio is used because companies might have higher or lower inventory at certain times of the year. Therefore, you might calculate it on a yearly basis, but as well on quarterly. This would be very interesting because some companies in developed economies, they make their sales generally in December very often, quite a lot, like book industry. They sell 1/3 of all books in month of December, coming to Christmas. And a reminder that this COGS is a measure of company's production cost of goods and services. It includes cost of materials, labor costs directly related to products, and fixed cost overheads that could be directly used in production. Now, because it's quite difficult to grasp it in technical way, so there is something called days sales of inventory. And days sales of inventory, it's a measurement. Measures how many days it takes for the inventory to turn into sales. So, of course, we use this inventory turnover into this calculation. It means we just take this inverse figure of turnover ratio and multiply it by 365. And this makes this concept of days that you need to turn over your stock. Of course, it has to be closely related with the data from the industry, because if the industry is generally having very large stocks for a long time, or relatively long time, like cars, automobiles, they have very large. So usually we compare this figure to the figure that is generally in the business, in this particular business. And now we have to make this review of our ratio analysis. Very nice that you have this in front of you, because what we do, we just take a certain figures from this financial statement, and with these figures we will do a exemplary inventory turnover calculation, which looks like that. We take costs of goods sold. Yes, it is here, 2020 and 12. Yes, 2012, and then we divide it by the average inventory, and then we have the figure. Now, when we want to calculate this, of course, we take this inventory turnover upside down, and we multiply by 365. Of course, the other way would be take 365 divide by inventory turnover. And we have concentrated very much on inventory, because this is the crucial part of the procedures related to the working capital calculations approach. It's very important because, it's very bad for the company where the money actually is stuck in inventory, particularly of raw materials, or even worse, when it's stuck in finished products that you cannot sell. It's the worst scenario whatsoever. Therefore, it's very important to watch inventories. So generally, we tend to express this turnover ratio not in like a ratio, like how many times it turns during a year. It's natural or instinctive to show it in number of days, because then it's like instinctively how many days we have this working capital covered. Yes, so this is the answer. And as I said, it's very important that company uses this inventory at a reasonable pace, because Not too much, not too less, because when it's too much, it costs money, obviously, because you stock it. But if you have too little of inventory and you are stuck because you cannot produce, wow, this is like catastrophe. So it has to be like as little as possible, but not really touching the ground. We will talk about this, about quantity to order, but this is very important. And as well, even if it's low, it doesn't mean that there is no problem at all in the company. It might be, and unless it's really cut into particular parts, like separately raw materials, separately work in progress, and separately finished goods, then you cannot see it. Obviously, for the management purposes, you could divide it for as many components as you want. And now we have, again, this review of ratio analysis. So we are now concentrating on these particular lines that we have in our income statement and other documents. And now I have to say something very important. You may not be happy about that, because there is a serious warnings about the names of particular ratios in different books. While preparing this particular lecture, I have used 7 different books, and in 7 different books there were 7 different definitions and 7 different names. So when you have any ratio concerning inventory turnover, receivables and payables, always look on the formula, how it is constructed. And it should be extremely prudent while using these ratios. And before you use any ratio in your analysis, you must have the formula and know exactly what comes in the formula. So there will be 2 pages now that they will sort of approach to organize this variety of definitions. Firstly, when we talk about receivables turnover, for example, we have this receivables turnover as sales to receivables. And now the first question, like the first 2 lines, what kind of receivables? Either like at the given date or at the period. And there is a construction to make this average receivables from current and the previous and period. And then relate the sales into receivables. Because this might be a very proper way of touching this. Then, when we talk about receivables, look, when you sell something, you could sell it, and you normally do in business, on a delayed payment. Like it will be paid in future. Absolutely standard procedures in Europe would be like 14 days or 30 days or 60 days or 90 days or 120. So, but as well, in some businesses it's quite popular, you sell on cash, like spot or even prepayment. But like in the moment the good leaves your warehouse for sale, it's already paid. So the question is, should we calculate all receivables? Because calculating these cash ones does not have any sense. I mean, logic sense. Because you want to know what happens with these receivables that are on delayed period. So what you do, you just take this credit sales and you divide by receivables. So you just take out from your analysis everything that is sold on cash. And of course, inevitably, you have a variation of that, which is this receivables turnover based on net credit in average version. Like you take the net credit sales, divide by average receivables. Hopefully it does not scare you, because you have like several formulas. Don't worry, when I will ask you in future about something to calculate, I will say at what formula it will be, like sales or net credit sales or basic ones or average ones. All right? Because now the next page will be even more scary, because there are some definitions like days sales in receivables, and it's like we take the measure that it's here, receivables turnover, but we express this in number of days. So we divide the 365 by receivables turnover, and now we know what is our average days of collecting receivables. As well, it comes in the version based on average receivables. Sorry, it's there. So when we take this, we call it days sales in receivables based on average receivables. All right? But then we have another definition, and often it comes like receivables collection period, because now we are concentrating only on these ones that are sold on credit for deferred or delayed payment. So we take this 365 and we divide by receivables turnover in a net credit version. And of course, as in the previous page, it's like this. We could as well base this on average receivables. Therefore, it comes like receivables collection period based on average, and it means 365 divided by this turnover there. So it's getting a bit complicated or scary at the moment, but I hope I explain it to you in a sort of logic step-by-step way. Now, when we want to do an example, for example, we have this sales on credits and a following illustration. How we calculate this? Because we from the management point of view, we need to have an information. What percentage of our sales is on credit in order to have this number of credit sales? Of course, here it's like other way around, because it's multiplied by 365. But properly, we should do it like on the previous page. But for like simplicity of calculations, and some authors insist on this way, then we have this result here. So in our case, this account receivable collection period will be like that. And now, when we still talk about a review of ratio analysis, it's very important to say it now. We have this table with the figures. I hope you remember, because it's very important, you remember the current ratio and quick ratio, at least. I mean, this would be the third ratio, hopefully you remember. But these two are by far the most frequently used, specifically in the question of working capital. Specifically because the question of working capital involves the question of inventory. So when you have inventory in it, you will use the current ratio, and there is a figure. And then when you have the quick ratio, you will take inventory out, or do it other way around by making the numerator by a sum, not a subtraction. And of course you could see that it's quite sizable difference. And of course prepaid expenses as well, because it's already there. You cannot take it out. It's already there. You just sacrifice that, of course. And now, So we have this couple of criteria how we do with inventory control, because we mentioned keep total costs down. Probably it's easier to say than to do, but let's have it in mind. We keep total cost down of inventory. Then at the same time, we have to remember that, of course, the whole existence of our business depends on the level of satisfactory service that we deliver to customers. So we cannot forget them in our analysis. They must be satisfied with the product, quality, delivery, way of payment, many things. And of course, because we have our inventory of raw materials, then we have to ensure that our production is smooth, running without any problems, because as well, it's hugely important for our business. And of course, it's very easy to say that we maintain this inventory as low as possible. But firstly, we have to remember that we have our standard fluctuations in our business. You know, normally during a year, we have peaks and downs of our production of certain reasons. It could be related to weather, to customs, like in agriculture, to weather, many things. I mean, if you are running a hotel in the mountains, you know that winter probably would be your peak season, particularly around in Europe, around Christmas and New Year time. As well, in summer you will have many people, but spring and autumn would be different. But then you have to take in your analysis as well some changes in behavior of customers, how the demand changes, what is the price, your price, competition prices, then for production raw materials, how is it available? Is it always available, or maybe only at some kind of harvest time, or how? So it's all into consideration. And then at the end, we have something that is here in a nice blog. How should we value our inventory? And this is a crucial thing. Probably you have heard about that, at least about FIFO and LIFO. You might have heard this in accountancy program, but we are not dealing with this from the point of view of accountancy. We just don't care about that. It doesn't matter to us. We need to find the concept of valuation, of management of our inventory. And let's start step by step. So the first one would be FIFO. Some people say FIFO, but I think it's rather FIFO than FIFO. So it's a valuation method, first in, first out. Yes, what it means? It means that assumes that assets with the oldest costs are included in income statement cost of goods sold. So if we take in our inventory some raw materials, like the oldest ones, these ones that first in to our inventory of raw materials, then we use in production, so we take the cost of these oldest ones, first in, first out. Maybe you had this on in your accountancy, but this is like an example. So let's assume that we have our raw material, and we use this FIFO concept, and we have 100 items that were purchased at $10, and we purchased the next lot of 100, but now we paid $15 per item. So this method of using FIFO would mean that we take from our stock of raw materials first these items that are at $10. I mean, if we produce, because if we are in trading business, we bought it and then we resell, right? Because we bought it in large quantity, then we resell in detail, right? And then we make some kind of premium. So, but we value this at the oldest one. So we just sell these ones at this price. And then after we sell these 100 items or we use into production, then the next items would be $15. And then so on, so on. Of course, there is another idea, and it's called LIFO, last in, first out. And it means that when we use something to production or we sell in resale principle, that we value this at the last price, the last that we paid. And the last that we paid, and it's the concept that makes, if it's in times of inflation, it's very useful because it always shows you like the last price that went into the stock. There are two basic ones, FIFO and LIFO, but then there are variations, and there is like FEFO, which is first expired, first out. And this is used in retail very often because you buy at certain date of consumption. And it doesn't mean at what time you just bought this, because you have to sell in your retail these ones that have the shortest days of consumption. So with the earliest possible date of consumption, it is sold, regardless of the date when it went to your stock. Another variation is called LOFO, lowest in, first out. And in this, you use the concept that you value your stock, currently used into your production or resale at the lowest price that you purchased, at the cheapest. The cheapest go first. And it's rarely used because, there are some reasons you could use. I do not say anything about how legal this is, because for financial accounting, I'm sure there are always principles for that. And I'm not very sure that, for example, LIFO is allowed in many accounting systems. These ones perhaps even not mentioned. And then you have another one called HIFO or HIFO. And it's like you always value your stock, used into production or resale, at the highest possible from what you purchased stock. Then as well, it's depending how legal it is, you could use this. And then, of course, on paper, it looks always very well when your stock is as cheap as possible, because you just take the highest out. Then you have another concept, which is called NIFO or NIFO. This one absolutely is impossible in financial accounting, but it's very useful in management accounting. Because what it means, this concept effectively means that you value this, what you take into production or resale, at the price that you know you will have to replace. You remember this concept from our productions several weeks ago, that you know already that you will have to value this at the replacement cost. Because in management it's very important that you know that it probably is getting to be more expensive. And therefore, you value what you put into production or resell at this next in, first out concept. Yes, again, it's used in an inflation periods quite often. And it's purely management accountancy approach. But what you say, yeah, hello, professor, but you just say about FIFO, LIFO, FEFO, LOFO, HIFO, NIFO, and what about the most obvious one? Yes, it exists. Of course it exists. Weighted average cost. It's called WAC or WACO, weighted average cost. Yes, and this is, as well, I don't know how it's legal in financial accountancy, it doesn't really matter, but in management accountancy it has a lot of sense. When you have a huge stock with many movements in and out, and with inventory of raw material that is not being spoiled during the time. Let's say there are some kind of metals that you have, and because you have a steel work or something like this, and then you have these metals on stock. I mean, you could have these metals all the time, for example. So perhaps one given metal, you just make the weighted average, always, and then you just use it in your production on weighted average method, and then you value your inventory basis on that. So these were these concepts that we had in valuing the stock. It might happen that I will ask you one time or maybe about something like this. And yes, this weighted average costs when they are identical. This kilogram of silver is a kilogram of silver, say, at the same clarity.